I think in the short term, there's a risk that equities suffer a bit more weakness. We're in a situation here now, I think, where we have rising yields and some uncertainties around whether or not it's going to impact the growth environment. So for equities, an environment of higher yields and good growth is fine. The risk becomes when you have higher yields and then concerns grow around a bit of a growth scare. Some of the data out of the US is weakening a little bit. So I think that there's a feeling in the market that maybe the Fed is trying to sort of weigh down on growth to get inflation under control. Now, time will tell whether or not that's actually necessary or not. But in the very short term, the pace of the increase in yields is just creating a little bit of additional uncertainty, therefore, around the growth environment and the earnings outlook. And I think that could weigh on equity markets just in the short term until perhaps this rise in bond yields starts to slow.
Graham, is there a risk of entry-level error when it comes to some of these sectors? I know a lot of investors have been playing catch-up, trying to reposition in the market, but they're behind some other participants that have been very quick around this yield story. And in particular, I cite banks. I mean, you look this morning, European banks again still supported, but it's been such a strong run, and in particular for some European names. If you're buying in at this stage, is there a risk that you're just a little bit too late to the party?
I think we have to think about tactics and strategy here. So what do I mean by that? From a strategic perspective, if we look out over the course of the next 6-12 months, I still think there's decent upside in the European banking sector. Valuations are ultimately, even now, really quite low relative to the last 10 years. And if we are moving into an environment over the next couple of years where we're going to get rate hikes from the central banks around the world, including Europe, then there's quite a lot of upside momentum behind the earnings story for banks. So longer term, I think that the sector is still in a good place. We've had sort of, if you like, 5 to 10 years of people not wanting to own banks. And maybe now we've had 5 to 10 weeks of people wanting to own banks. So there is a big positioning support longer term. But your questions, I think, is a good one because the sector's moved so far, so fast over the course of the last month or two that it would make some sense at this point, I think, for a bit of a pause. So our recommendation would be to look for a further entry point in banks, but it may be that a little bit of patience here gives you a slightly better entry point.
Energy has been incredible over the last year, Graham, and the moves that we're now seeing around the headline price per barrel on WTI and Brent are extraordinary. But I guess, given the geopolitical situation at the moment and some of the other drivers of underinvestment in new finds, perhaps not a big surprise. Do you stick with the energy trade through the rest of 2022? How do you play the equity in this space?
Yes, I think you do. And I think actually, although both banks and energy have had a very strong run recently, I would actually be quite happy to continue buying energy at this point, because it offers us a little bit of a hedge in the short term if there are some additional uncertainties across the market from geopolitics and other factors. So we get a nice hedge there. There is definitely upward momentum in commodity prices at this time, and the sector is very cheap. And if we think about the global economy, obviously there are large parts of the global economy that really have not properly reopened yet. So what's happening within the energy space in particular is there's just a very big demand-supply mismatch. And it's very hard to see how that's going to improve, because if we look out for the rest of this year, the demand outlook should pick up as the global economy gathers more momentum and we get some reopening. But as we know, these oil companies have got very, very little appetite to invest to generate additional supply. So I think we're going to end up with very tight commodity markets within the energy space for quite some time. And I look at some of these large cap oil stocks in Europe, and they just still look very cheap, and they're giving an awful lot of cash back to their shareholders. And we've got big earnings upgrades because, of course, week by week goes by, the oil price goes up, the analyst community has to react to that and continue to raise their earnings estimates. So you've got lots of free cash flow, it's coming back to shareholders, there's positive earnings momentum, valuations are still low. And again, as with banks, people have been underinvested in this sector for many years. So actually, I would we'll continue to be very happy to recommend putting fresh capital into the energy sector at this time.